You are programmed to always chase price, always one step behind the market. That's because the big players hunt liquidity, creating the moves others try to follow. Today I'll teach you how to spot and trade liquidity, just like the pros. When you first started trading, you probably learned about support and resistance, chart patterns, and other basic stuff. Many brokers even offer free education on these topics. But why? It's not just to be nice. They want lots of traders using the same strategies. Because this creates predictable liquidity that can be exploited. Think about it. If most traders are using the same methods, it's easy for big banks and institutions to predict what they'll do. They can use this knowledge to move the market in ways that benefit them. It's like setting up dominoes. Once they're all lined up, it just takes a little push to create a big effect. This is liquidity. In its simplest form, liquidity refers to the orders or money present in the market. Market prices move based on the flow of buy and sell orders. More buying pressure pushes prices up, while more selling pressure pushes prices down. For substantial price movements to occur, the market needs to interact with areas of high order concentration, also known as liquidity. So liquidity means all the buy and sell orders waiting to be filled. Now, here's the interesting part. If there isn't enough liquidity, the big players, the smart money, will create it. For big traders like banks or hedge funds, liquidity is critical. They deal with large amounts of money. In less liquid markets, their big trades can push prices around a lot. This makes it hard for them to buy or sell without losing money. Now, if you understand where liquidity sits, you can identify magnet areas, those price levels that attract price movement. Your main task is to find liquidity pools. Liquidity pools are like busy trading spots in the market. They're areas where lots of buy and sell orders gather, and they form at key price levels. These could be previous highs or lows, round numbers, or other important points. We'll talk about these in a minute. Now, traders often place their orders at these levels, creating a cluster of potential trades. And there are different types of liquidity pools. Major liquidity pools, which form at the highs and lows of longer time frames. These are big, important levels that many traders watch. You might see them on weekly, monthly, or even yearly charts. Medium liquidity pools that show up on shorter time frames, like 1-hour charts. These are still significant, but not as big as the major pools. And minor liquidity pools that appear on very short time frames, like 1-minute or 5-minute charts. These are smaller and might only matter for very short-term traders. Liquidity pools work by attracting price. When price approaches a liquidity pool, a few things can happen. It might reverse, as lots of orders get filled at that level, or it might pause there before continuing. Sometimes, it might even break through quickly if there's enough momentum. And big players are constantly trying to hunt these liquidity pools. They often push price to these levels to trigger a bunch of orders, causing a sharp move. So liquidity zones are key areas where smart money players often target to protect their positions and to trap other traders. These zones act like magnets for price, drawing it in and often causing significant moves. So let's talk about each type of liquidity zone and how smart money uses them to their advantage. First area is around structural highs and lows. These are major turning points in price action. The peaks and valleys you see on a chart that stand out from the rest. Smart money loves these spots because they know traders often place their stop losses just beyond them. Let's say we have a strong uptrend with a series of higher highs and higher lows. Traders often jump on these trends, placing their stops just below the most recent low. And smart money knows this. They often push the price down, breaking that low, and triggering all those stop losses. This flood of sell orders drives the price down further, often before smart money steps in to buy, at a discount. The same happens in downtrends. Retail shorts place their stops above recent highs. Smart money spike the price up, hit those stops, then drive the price back down. To spot these zones, look for clear swing highs and lows. The more obvious they are, the more likely they are to attract attention. Trend lines are another favorite tool of traders. The diagonal lines that connect a series of lows in an uptrend or highs in a downtrend. They're simple to draw and easy to understand, which is why so many traders rely on them. Big players often target these trend lines, especially long-standing ones. They know that many traders will have stop losses placed just beyond these lines. By breaking a significant trend line, they can trigger a cascade of orders. For instance, in a long-standing uptrend, many traders will be long, with their stops just below the trend line. Smart money might push the price down to break this line. As stops are hit, more sell orders flood in. Smart money can then step in and buy at lower prices before resuming the uptrend. Equal highs and lows, also known as double tops and double bottoms, are also exploited by smart money. These patterns form when price reaches the same level twice, creating a potential reversal point. Traders often see these patterns and place their trades accordingly. For a double top, they might go short, with a stop just above the equal highs. For a double bottom, they might go long, with a stop just below the equal lows. Smart money knows this and often pushes the price just beyond these levels to trigger stop losses before reversing. This creates a liquidity pool that they can use to their advantage. Trading sessions, particularly the Asian, London, and New York sessions, often create their own ranges. These ranges can become significant liquidity zones, especially at their highs and lows. Big players often target the session's highs because they know many traders use them for entries and stop placements. For example, many traders use the Asian session range as a guide for the London session. They might place buy orders above the Asian high and sell orders below the Asian low. Smart money might push the price just beyond these levels to trigger these orders, creating liquidity that they can trade against. They might spike the price above the Asian high, triggering buy orders, only to sell into this liquidity and push the price back down. The previous day's high and low are other significant levels that many traders watch. They often serve as support and resistance levels for the current day's trading. Again, the big boys frequently target these levels. For instance, many traders place buy orders just above the previous day's high, expecting the upward momentum to continue. Smart money will push the price up to trigger these orders, creating a pool of liquidity. They can then sell into this liquidity, potentially reversing the price direction. The previous week's high and low also attract a lot of attention. You might not even know where those levels are. These levels often act as key support and resistance on higher timeframes. And smart money often exploit these levels, knowing that many swing traders and position traders use them for stop placement and entry orders. For example, in a downtrend, many traders might place sell orders below the previous week's low, expecting the trend to continue. Smart money often push the price down to trigger these orders, creating a liquidity pool they can buy into. Supply and demand zones are other liquidity zones. These are areas where price has shown significant rejection in the past, and these zones are prime targets for smart money manipulation. Smart money know many traders place their orders around them. For example, many traders might place buy orders at a strong demand zone. Smart money might push the price into this zone, triggering these buy orders and creating liquidity. They can then potentially sell into this liquidity, driving the price even lower. That's why you see so many demand zones that should work in theory, but in reality, they fail. The same happens with supply zones. Traders often place sell orders at these levels, expecting price to drop. Smart money might spike the price into the supply zone, triggering these sell orders, then buy into this liquidity to potentially drive the price higher. Fair value gaps are also targeted. These are areas on the chart where price has moved rapidly. These gaps often act as magnets for price, drawing it back to fill the gap. Smart money often uses these gaps as targets. For example, if there's a bullish fair value gap below the current price, many traders might place buy orders in this area, expecting price to come back and fill the gap. Smart money might push the price down through this level, triggering these buy orders and creating liquidity. The same happens with bearish fair value gaps above the current price. Traders often place sell orders in these areas. Smart money might spike the price up through the gap, triggering these sell orders. That's why maybe 90% of fair value gaps fail, but that's a topic for another video. Round numbers ending in 0 or double zeros are psychologically significant levels that attract a lot of attention. These levels are prime targets for smart money manipulation. Smart money knows that many traders place their orders around these round numbers. They might place buy orders just above a round number or sell orders just below it. The big boys often push the price to these levels to trigger these orders, creating liquidity that they can trade against. For instance, if there's a round number at a $50 level, many traders might place buy orders slightly above it, expecting the price to rise above this level. The big boys might push the price up to trigger these buy orders, creating a pool of liquidity. They can then potentially sell into this liquidity, driving the price back down. Understanding all these liquidity zones and how smart money targets them is key. It helps you avoid common traps. As you practice, you'll start to see patterns. You might notice that price often reverses after taking out a previous high or low. Or you might see that certain levels keep causing price to pause or reverse. And please don't just draw liquidity zones all over your chart. Focus on the most important ones. Too many zones can make your analysis confusing. Also, pay attention to how price reacts when it reaches a liquidity zone. Does it reverse sharply? Does it pause and then continue? Or does it blow right through? This can give you clues about the strength of the move and what might happen next. You might notice that certain types of zones work better in certain market conditions or for certain currency pairs or stocks. This is where keeping a detailed trading journal with your findings can be incredibly valuable, allowing you to refine your strategy over time. Now, let's talk about liquidity inducement. Inducement is about creating situations that make other traders want to trade at certain levels. This creates available liquidity for bigger players to use when they want to enter or exit their positions. To understand this better, let's look at how the market is structured. When we look at charts, we see highs and lows. Above these highs, we assume there's buy-side liquidity, and below the lows, we assume there's sell-side liquidity. Buy-side liquidity is all the liquidity that buyers will use, created mainly by stop-loss orders of sellers and buy-stop orders of buyers. In a bullish market, price often uses buy-side liquidity to fuel the next upward move. To have a big bullish move, the market needs sell orders to generate more liquidity. Also, the buy orders from stop losses of sellers generate more buy orders, which is why you often see a surge in buying when price breaks out. Sell-side liquidity is the opposite. It's the liquidity that sellers will use, created mainly by stop-loss orders of buyers and sell stop orders of sellers. Imagine you see a double bottom on your chart. Price hits the same low point twice, forming a support level. Many traders might want to buy at this support level. Now think about where these traders would put their stop losses. They'd likely put them just below the lows. This creates a pool of sell-side liquidity below the lows. This is important because big players need this liquidity. They can't just jump into the market with huge orders. That would cause wild price swings and could work against them. Instead, they use liquidity inducement to their advantage. These big players create patterns or situations in the market that encourage other traders to place their orders in predictable spots. This builds up pools of liquidity that the big players can then use to enter or exit their positions. Now, before we continue, let us know in the comments what topics you'd like us to cover, and please drop us a like to help us with YouTube algorithm. Now let's talk about how big players use this liquidity. They often create what's called a liquidity sweep. It's when big players in the market try to take advantage of areas where there's a lot of buy or sell orders waiting. These areas are like pools of money just sitting there, ready to be used. For instance, if there's a strong support level with many stop losses just below it, price might sweep down to hit those stops before reversing. This action sweeps the liquidity, letting larger players fill their orders. Knowing about liquidity sweeps can help you in two main ways. First, you can look for where sweeps have already happened, as this might show where big players have been active. Second, you can use this knowledge to guess future moves by spotting where available liquidity might be. One way to trade these liquidity sweeps is by identifying the inducement before a potential zone of interest. This is where price action might encourage traders to enter positions, creating more liquidity for a potential move. For example, if you're looking at a possible buy zone, you might see price dip below a previous low before the main move up. This dip could make sellers enter short positions or exit longs, creating liquidity that larger players can use to enter their long positions. Liquidity goes hand in hand with market structure. Market structure refers to the overall pattern of price movement. It's about identifying trends, key levels, and the flow of the market. Liquidity is about where buying and selling activity clusters. These two concepts work together to shape market behavior. Here's how they interact. Areas of high liquidity often become key points in the market structure. A level with lots of buy orders might become a strong support level. If price keeps bouncing off this level, it becomes part of the market structure. Key structural levels tend to attract liquidity. Traders often place their orders around important structural points, like trend lines or previous highs and lows. This creates a feedback loop where structure and liquidity reinforce each other. Breaks in structure can drain liquidity. When price breaks through a key structural level, it often leads to a surge in trading activity. This can temporarily drain liquidity from other areas as traders rush to adjust their positions. Liquidity flows with structure. In a strong trend, liquidity tends to cluster in the direction of the trend. For example, in an uptrend, you might see more liquidity above the current price as traders anticipate further rises. Structure helps predict liquidity. By reading the market structure, you can often predict where liquidity might be. For instance, after a series of higher lows in an uptrend, you can expect liquidity to gather below each of these lows. Liquidity confirms structure. Sometimes the way price interacts with liquidity can confirm or deny the current market structure. If price easily breaks through what should be a liquidity-rich level, it might signal a change in the overall structure. Both liquidity and market structure guide price movement. Price often moves towards liquidity, but within the constraints of the larger market structure, and institutional activity links them. Big players in the market often use their understanding of both liquidity and structure to plan their trades. Both liquidity and market structure change over time. Just as market structure evolves, so does the distribution of liquidity. What was a key liquidity level last week might not be as important now. So keeping track of both helps you stay in tune with the market. The interplay between liquidity and structure can help you spot truly important levels in the market. Areas where structural levels align with high liquidity are often the most significant. In trading, we often talk about market structure shifts, the big changes in the overall trend of the market. Inducement often plays a role in these shifts. For example, before a major trend change, you might see price action that looks like it's continuing the old trend. This can trick traders into entering positions in the direction of the old trend, creating liquidity for the smart money to use when reversing the market. Also, liquidity inducement is part of a larger market cycle. The market typically goes through phases of accumulation, markup, distribution, and markdown. Liquidity inducement often occurs during the accumulation and distribution phases, as smart money prepares for the next significant move. During accumulation, for instance, you might see price action that looks choppy and directionless. This can discourage retail traders and shake out weak hands, while smart money quietly builds positions. The apparent lack of direction is itself a form of liquidity inducement, creating opportunities for larger players to buy at favorable prices. This is why it's key to look beyond just price action and also consider volume, momentum, and other factors that might indicate the true market dynamics. Liquidity inducement isn't something bad. If you can spot it happening, you might find good trading signals. For entries, look for areas where there's a lot of liquidity. When the market is going up, look for buy entries just below recent lows. That's where big players often buy, scooping up all the sell orders. When the market is going down, look to sell just above recent highs. That's where big players often sell into all the buy orders. For exits, think about where other traders might have their stop losses or take profit orders. These create pools of liquidity. As price approaches these areas, be ready to exit your trade. The price might reverse once it hits these liquidity pools. Every time the market makes a new range, mark the high and low. If you are trading in this range, you might enter at one end, where there's internal liquidity, and exit at the other end, where there's external liquidity. Also, you want to trade where there's low resistance. This means there should be little stopping for the price to move in your favor. Start on a bigger time frame, like the daily chart. Mark major liquidity levels. Move down to a smaller time frame, like the 1-hour chart. Look for price approaching your marked liquidity levels. As price gets close to a liquidity level, switch to an even smaller time frame, like the 15-minute chart. Watch for signs of a stop hunt, a quick spike through the level, followed by a reversal. If you see this, get ready to enter a trade in the direction of the reversal. Also, don't jump on every breakout. Wait for the price to show it's really going to keep moving in that direction. And always consult multiple time frames. Check larger time frames to see if a move fits the bigger picture or if it might be inducement. If you see the price quickly reject a level after breaking it, be ready for a possible reversal. And don't put your stops right at obvious levels. That's where inducement often targets. There are several tools and indicators that can help you spot and analyze liquidity in the markets. First one, volume. This is one of the simplest and most effective tools. High volume often shows high liquidity. So look for volume spikes, which can indicate liquidity events. Second, market depth charts. These show pending buy and sell orders at different price levels. They can help you see where liquidity pools might be forming. Third, time and sales, or tape reading. This shows real-time trades. Large trades or clusters of trades at certain prices can indicate liquidity. Fourth, order flow indicators. These advanced tools try to show the balance of buying and selling pressure. And fifth, volume profile. This shows where most trading has happened at different price levels, helping identify high liquidity zones. It's best to use a mix of tools and combine them with market structure and price action. Also, these tools don't directly show liquidity. They show things that often relate to liquidity. You still need to interpret what they're telling you. Liquidity and order flow analysis are closely linked. Order flow analysis is all about understanding the buying and selling pressure in the market. This pressure often shows up as liquidity. Order flow analysis looks at the actual orders coming into the market. It tries to spot where big players are buying or selling. Basically, order flow analysis can help you find where liquidity is building up, when liquidity is being used up, and potential price levels where big players might be active. In order flow analysis, you need to get familiar with several concepts. First one, volume clusters. Order flow analysis often looks for clusters of orders at certain prices. These clusters are actually liquidity pools. Next concept is absorption. When a price level absorbs a lot of orders without moving much, it's often a sign of high liquidity. Here's a familiar concept, imbalances. Order flow tools might show imbalances between buy and sell orders. These imbalances can create or drain liquidity. It's a lot to talk about, but that's a topic for another video. Retail traders like you and me can level the playing field by using liquidity analysis to compete with institutional traders. Here's how. Know the closest liquidity pools. Mark the areas where lots of buy or sell orders cluster. When price hits these spots, it often bounces or breaks through fast. You need to be ready for both scenarios. Watch for traps and liquidity sweeps. Big players set traps to trick small traders. They often push price to key levels. Don't fall for these fakeouts. Use multiple timeframes. Check both higher and lower timeframes. This gives you a fuller picture of liquidity across different market views. It helps you spot potential reversals or continuations more accurately. Track order flow. Pay attention to how orders are coming in. Look for big buy or sell walls in the order book. These can signal where institutions are placing their orders. Identify liquidity gaps. These are areas on the chart with little trading activity. Price often moves quickly through these zones. Knowing where they are can help you set better entry and exit points. Study market structure. Look for key swing highs and lows. These often mark areas of high liquidity. Focus on session overlaps. When major trading sessions overlap, liquidity tends to increase. This can lead to bigger price moves. Use these times to your advantage. Many traders jump on breakouts only to get burnt. Instead, look for pullbacks to liquidity zones after a breakout. This is often where smart money enters. Use volume profile. This tool shows you where the most trading has happened at different price levels. High volume nodes often act as strong liquidity areas. Now, if you want to learn other smart money tactics, you need to watch one of these videos next.